Yes, good morning, Rajan. Wait for some time being so that students can able to come. Good morning. Good morning, Aryan. Okay, let us start now. So, good morning, everyone. Now, today we will do the vital and the most important part of this banking, which is the most important function of the central bank. The most important function of commercial bank was your money creation or credit creation, which is done by whom? Which is done by commercial bank. Now, the most important function of central bank is how the central bank control the money supply. Money supply means the money which is in the hand of general public. Okay, good morning everyone. Concentrate now, concentrate. No need to comment. Good morning. Now concentrate everyone. Okay, so money supply means this money which is in the hand of the public. So what the central bank will do now? The central bank will, how it will control or manage this money supply in the hand of public. You will see there is various policies which will be done or brought forwarded by central bank. Okay, so now uh, first of all, the policy, you will see that it's a repo rate. Before coming to this repo rate, I will tell you a short story for your own life only. You will just able to compare this thing with this repo rate. Now, when you have large amount of money, or the money which you are having in your hand is in excess. So when there is excess money, what you do? You used to spend it. Okay. The goods which is not required, not essential also, you purchase those goods also unnecessarily. You spend the excess money which you have in your hand. Now, if your parent sees that no, my son is getting excess money, so he or she is spending too much, so try to control that money which is in his or her hand. Your father or your mother or your parents will implement various policies, various tricks to control your excess money which is in your hand. So your parents will become the central bank. Think that your parents is your central bank and you yourself is your commercial bank. So what happens? The commercial banks has, if the commercial banks has excess of money, then what the central bank will do? The central bank will try to control that money which is in the hand of commercial bank and also in public hand. Or in other words, you know that central bank cannot able to come directly with the contact with whom? With public. Okay, the central bank cannot come direct contact with public. So public has money supply in their hand. So more money in the public hand, the public will spend unnecessarily. So how to stop that unnecessary spending in the hand of public or from public? If commercial bank fails, central bank come indirectly to solve this problem, and this solving this problem only controller of money supply and credit. And all the policies are what? Repo rate, bank rate, open market operation, legal reserve requirement and margin requirement. So what I have told? Repo rate, bank rate, open market operations, legal reserve requirements and what? And your margin requirement. Okay, these are all the policies which the bank will, or the central bank, not bank, the central bank will play some role so that the money supply which is in the hand of public can be controlled not directly but indirectly. Sometimes it is directly also, sometimes it is indirectly also. We will come one at a time. What is repo rate? First of all, you just see that I will read it first, okay? Then I will explain. Repo rate, another name of repo rate is your repurchase rate. So in the question it may comes that what do you mean by repurchase rate, or explain the concept of repurchase rate, or it will be told that how this repurchase rate can able to control the money in the hand of public. Okay, now repo rate is the rate at which the central bank of a country lends money to commercial banks to meet their short-term needs. So what it is telling here? Whenever the commercial bank requires money for a short-term period, it approaches to whom? To central bank. It approaches to central bank. Okay. Now, when there is increase in the borrowing of public, means when the public starts borrowing in an increasing amount from commercial bank, we will see how the central bank control this credit or borrowing with the help of this repo rate. So what it telling? It is telling that the public used to borrow from commercial bank whenever he or she requires. Now, when the public used to borrow money, either the public is in very need or the public will borrow in case of unnecessary spending. Okay, so you will see with the help of this repo rate how the central bank control the money in the hand of public also, or the control the borrowing of the public from commercial bank. So a question may come to you, why the central bank will manage? The commercial bank can only stop giving loan to the public, is it? But you just see, children, commercial banks main activity is what? I have told Commercial bank's main activity is money creation, to give loan. Okay, whatever loan, how much amount loan the public will ask from commercial bank, the commercial bank will provide it. Why? Because they will get profit, they can earn profit, they can able to increase the initial deposit from 1000 to 5000, which I've told you in the previous class in money creation or credit creation. So commercial bank will not stop providing loans to the public. Its main aim is to earn profit. Okay, so the central bank has to come in the field to stop or to control this borrowing from commercial bank. Clear up till this much? Now we will see with the example. Listen very carefully. What is the role of this repo rate? See, for example, public comes to the commercial bank, for example SBI, and tells bank that I need loan of 50,000 rupees. Okay, so the commercial bank, if it does not have 50,000 rupees at that particular time, what the commercial bank will do? He will come to the central bank and he will ask for loan from central bank of 50,000 rupees. Okay, now the central bank tells to SBI, okay, I will provide you loan, but you have to give me 5% interest, okay, for that 50,000 rupees which I am giving to you. Understood? So this 5,000 is what? 5% is what? 5% is your repo rate, which is charging extra by central bank from commercial bank for that borrowing money. And you know that if you want to borrow from anybody, you have to pay some interest for that money. Okay, now the commercial bank sees that I have to pay central bank 5% repo rate. Okay, now the commercial bank lends that money 50,000 rupees to the public and tells public, you have to pay me 8% interest for that 50,000 rupees. So how much profit this commercial bank making? How much profit this commercial bank making? 8% minus 5% equals to 3%. So 3% the commercial bank is making profit. Okay, this is clear. Okay, the transaction completes here. Now day by day the public every time coming to the commercial bank for loan, and the commercial bank again coming to the central bank for loan, and the process continues for many times, for several times. So the central bank thinks that no, I have to stop this borrowing business of the public now, because there is too much of borrowing which is of no use. I have to reduce it, I have to control, because by borrowing every time, by lending money every time to the public is having huge amount of money in their hand. Okay, and that is not good. Money supply too much in the hand of public is not good. Now what the bank has, central bank has thought, see, now the borrowing increasing day by day of public, then central bank need to control. But how? Day by day the borrowing is increasing from the public side to the commercial bank, and the commercial bank is asking loan from the central bank. So how the central bank will control? Again see the case. Public comes to commercial bank for 50,000 rupees as a borrowing loan. Give me loan of 50,000 rupees. Public come to the SBI Now what happens? SBI at that particular moment does not have that 50,000 rupees. So what it will do? Commercial bank comes or SBI comes to central bank again that please provide me loan of 50,000 rupees. I am in need. Okay. So the central bank now it will work on it. Reduce the borrowing. How? Central bank tells the commercial bank, you have to pay me 10% repo rate for that same 50,000 rupees now. I have increased the repo rate. Okay. So commercial bank comes with that 50,000 rupees. He lends the money to the public and tells the public, you have to pay me 15% of interest for that same 50,000 rupees. So what is the profit the commercial bank is incurring? 15% minus 10%. 5% of profit the commercial bank is making. So the public now will think that previously I was paying 8%, now it has increased to 15%. I will be running in loss. Okay, so I don't want to borrow. I don't need money. I don't want loan. So in this case, what happens? The lending or the borrowing process between commercial bank and public has reduced, or day by day it reduced or reducing. For whom? For the central bank only. Because the central bank has increased the repo rate from 5% to 10%, the borrowing and the lending process between this commercial bank and public has also reduced. So, this is the working of repo rate, how the central bank with the help of this repo rate control the borrowing and the lending of money between commercial bank and public. Okay, so formula of repo rate no need to required now. Sneha, you just go about this process. Repo rate is being done. It is not a formula. You will not do any sums related to this. It is a concept. Repo rate is being charged by central bank by its own. Okay, repo rate is it charged by the central bank by its own according to the need. 5%, 10%, 12%, 15%. There is no particular formula about it that what is the formula, because it's a central bank, it's an autonomous apex body, supreme body. It thinks that what repo rate it should be and it declares it. Okay. Now, the same process is of bank rate. Whatever you have done in this repo rate, the working process, how the repo rate is being, the same is the case of bank rate. So, what is the difference between repo rate and bank rate? Bank rate is for long term period. What is it telling here? It is also known as discount rate. Bank rate is the rate at which the central bank of a country lends money to commercial bank to meet their long term needs, but repo rate is of about short term needs and bank rate is of about long term rates. Same as the repo rate, only repo rate was for short term need and bank rate is for long term need. The process that public, commercial bank, central bank process, or the working or the calculation, okay, which I have shown you in the repo rate is as just same in the bank rate. In place of repo rate, it will be bank rate. So here I have told about central bank charged 5% repo rate from commercial bank. It will be 5% for bank rate. It will be 5% bank rate from commercial bank. It will be 10% bank rate from commercial bank. So I will read the repo rate which is given it in your book. One time glance of it. Okay, see what is it telling. Repo rate is the rate at which the central bank of a country, RBI, in case of India, lends money to commercial banks to meet their short-term needs. The central bank advances loans against approved securities or eligible bills of exchange. An increase in repo rate increases the cost of borrowings from the central bank. It forces the commercial banks to increase their lending rates, which discourages borrowers from taking loans. It reduces the ability of the commercial banks to create credit. A decrease in the repo rate will have the opposite effect. Okay, if there is a decrease in the repo rate, what happens? Increase in the repo rate reduces the borrowing capacity of the public. Decrease in the repo rate increases the borrowing capacity of the public. Depending on the situation, the RBI will decide either to increase the repo rate or to decrease the repo rate. Coming to the bank rate or discount rate. Bank rate is the rate at which the central bank of a country, RBI in case of India, lends money to the commercial banks to meet their long-term needs. RBI has been actively using bank rate to control credit. Bank rate has the same effect as that of repo rate. That is, an increase in bank rate increases the cost of borrowings from the central bank, which leads to increase in lending rates by commercial banks. It discourages borrowers from taking loans, which reduces the ability of commercial banks to create credit. Okay, this is total about repo rate and bank rate. Next point you will be coming is of open market operation, or it is being written in short form OMO. Now what is this OMO? First of all, I am reading. Buying and selling of government securities. Government securities means what? Shares, bonds, debentures of government. Okay. By the central bank from or to the public and commercial bank. Now, before coming to this OMO, I am giving you another example of it. When I will buy product from you, what I will do after buying the product, I will pay you the price of it, no, in terms of money. Now, when you are selling product to me, I will be paying a money to you or the price of that product. What happens then? A money comes in your hand. And when you buy products from me, you purchase products from me, or I sell products to you, what happens? You pay price for the product to me, and what happens? The money in your hand reduces. Is it? If you have 50 rupees in your hand, you are buying biscuit packet from me, 20 rupees. You pay 20 rupees from that 50 rupees. Now how much is cash in hand in your? So 30 rupees is remaining. So from 50 it has reduced to 30. Keep this concept in your mind, then continue this one. Buying and selling of government securities, shares, bonds, debentures, by whom? By the central bank. Means central bank will now buy or sell the government securities. To whom? Either to the public or to the commercial bank, whichever it requires. Okay. Now we will see how with this instrument OMO, central bank controls money supply and credit. You will see how. First of all, sale of securities or shares and bonds by the central bank means what? Central bank is selling some product. Product, I am telling you just a word. It is not going through with this security. To understand you, let you understand, I am telling. Central bank is selling some product. The product is shares, bonds. Now when central bank is selling to somebody, what happens? Some money will be taken by central bank, and the person whom the central bank is selling these shares or bonds or securities, that person will be reducing his or her own money. So sale of securities by central bank reduces the reserve of commercial bank. Okay, so what is it telling? The central bank is selling some shares and bonds to commercial bank, and whenever the central bank wants to sell, even if the commercial bank does not require it, the commercial bank is bound to purchase it. Okay, forced to purchase it from whom? From central bank. Okay, so when central bank sells product or shares and debentures to commercial bank has to pay for those shares and bonds. And what happens? The reserve which was in the hand of commercial bank reduces, which affects the commercial bank's ability to create credit and decrease the money supply. Simple thing. What is the simple thing? If the commercial bank has 50,000 rupees in its hand, and central bank tells that, okay, I am selling shares and bonds, you have to buy it at a price of 30,000 rupees. So what happens? Commercial bank's reserves reduce from 50,000 to 20,000. 30,000 it has bought shares and bonds. So automatically the ability of lending money to the public, ability of money supply in the hand of the commercial bank reduces. Okay, same thing. Purchase of securities by central bank increases the reserve and raises the commercial bank's ability to create credit and increase the money supply. Same thing. If central bank purchase some shares and bonds from the commercial bank, what happens? Money comes in the hand of commercial bank, and when reserve increases in the hand of commercial bank, what happens? The commercial bank can able to lend money to the public. Now I have told here, given you the example of commercial bank. Okay, commercial bank, the transaction is being done between whom and whom? Central bank and commercial bank. Okay, so this may be the case that central bank can sell or purchase security directly from public also. I have told here, see, buying and selling of government securities by the central bank from or to the public and commercial bank. It may be commercial bank, it may be directly to the public, whichever the central bank wants. If the central bank thinks that there is many money supply, their money supply is increased in the hand of commercial bank, it can increase or reduce it. If central bank sees that their money supply is very much in the hand of general public, the central bank directly can make the transaction of selling and purchasing of the shares, bonds and debentures or securities from the public directly. In this manner also the central bank can able to do what? Able to increase or decrease the money supply in the hand of commercial bank and public. Okay, I am coming with the next instrument is what? Legal reserve requirement, not ratio. LRR is different. It is told as legal reserve requirement. But in commercial bank money creation or credit creation, you have done what? Legal reserve ratio. Both things are different. Don't confuse it. Okay. It is also known as variable reserve ratio. To maintain certain reserves. I have told you commercial bank has to maintain certain reserve with either with himself or either with the central bank. CRR, which have come through in custodian of cash reserve in function of central bank yesterday, which I have done. Okay, commercial banks are obliged to maintain certain reserve. First, CRR, cash reserve ratio, minimum percentage of reserve which the commercial banks are obliged to keep with the central bank. So minimum ratio which the commercial bank has to keep as a reserve with the central bank. Okay, so this reserve either the central bank may increase, this reserve either the central bank may decrease. The central bank may tell that okay, you have to keep and 20% of your total asset with me. Total asset means financial asset. It may increase this reserve, it may reduce this reserve according to the requirement or need by whom? By the central bank. This is the CRR. Okay. Okay, Tanisha has told, please repeat once again, sir. Can't understand. Okay, I am telling you once again. Listen, I have told you yesterday CRR. What is CRR? Sometimes the commercial bank has to keep some reserve with central bank. Now your father goes to bank to save some money, no? For what? For future need. If anything happened in your family, okay, anything occurs in your family, money is required to support it, to control it. So saving money is required. So now your father goes to the commercial bank to save money. Okay, then commercial bank, where they will go to save money? Commercial bank goes to the central bank to keep some minimum reserve for future need. So sometime the commercial bank keep with the central bank some reserve, it is known as CRR. And sometime the commercial bank keep some reserve with itself. For example, your father when keep some money as a saving money or stock in your almirah or etc., where in at your home also some money is kept, no, aside. Okay, so that is your father is keeping money with himself. Okay, so when the money is being kept as minimum percentage of reserve which is kept with the central bank, it is CRR. And when minimum percentage of reserve which the commercial bank keep with themselves, means with them only they keep some money as a reserve, it is known as SLR, statutory liquidity ratio. Now this rate, how much they will keep with central bank, how much they will keep with themselves, is being decided by central bank itself. The commercial bank will not decide. The central bank will decide, okay, you will keep this much with me, you will keep this much with yourself. So this order is being given by central bank itself. Okay, so either the central bank may increase this or rate, either the central bank may reduce this rate. Whichever the central bank requires, it can do. In this manner it can able to do what? It can able to maintain it. Okay, thank you, Tanisha. Now last year comes about your margin requirement. What is this margin requirement now? The difference between the amount of loan and market value of the security offered by the borrower against the loan. What is this thing, students? The difference between the amount of loan means you are, for example, taking loan from SBI 50,000 rupees, which I have told, and market value of security offered by the borrower against the loan. Means when you are taking loan, you have to keep something, no? You can tell it as a mortgage. You have to keep something against that loan. Okay, so you're keeping your shares, bonds, debentures, okay, liquid assets. These are known as liquid assets. Shares, bond, debentures with the commercial bank. I'm telling it as a with the commercial bank. So if the all the cost of those shares, bonds which you have given to the commercial banks against that loan cost is 70,000. Okay, the cost of all those shares, bonds which you have given against that loan is 70,000. So what is the difference between the amount of loan and the cost of those securities? 70,000 is your total which you have given shares amount, minus 50,000 you are taking the loan. So 20,000 is your margin requirement. Means 20,000 extra you are giving in for the to the commercial bank. Now this margin is being set by the central bank itself. Means you have given 70,000 valuation things, no, to the commercial bank in order to get 50,000 rupees loan. Okay, now central bank will tell, no, you have to keep 1 lakh rupees minimum asset, then you can able to get 50,000 rupees as loan. So either the central bank can increase that valuation, either the central bank can decrease that valuation. Okay, now by increasing this valuation, what happens? You will tell, no, I don't require loan. I have to, for 50,000 rupees, I have to pay 1 lakh rupees as a, I have to keep with you 1 lakh rupees. I don't require. So what happens in this way? Indirectly, the central bank can reduce the borrowing capacity. In this way, it can increase also. The central bank, if sees that okay, the people's or the public requires, yes, of course they require money. So what the central bank will do? It will reduce this valuation to, okay, you have to, you can take 50,000 rupees, you have to keep assets only 60,000 rupees. Means 10,000 rupees will be the margin requirement. So depending on the central bank's requirement, margin requirement, the borrowing and lending will be decided. Coming to the bookish language, you can see what is written here. You can able to understand more nicely. Margin requirement. Margin is the difference between the amount of loan and market value of securities. Wait for 1 second. Wait. Okay. Margin is the difference between the amount of loan and market value of the security offered by the borrower against the loan. If the margin fixed by the central bank is 40%, then commercial banks are allowed to give a loan only up to 60% of the value of security. So see this 40%, how much the valuation will be kept as a mortgage with the commercial bank is being decided by the central bank itself, and remaining 60% of it they can provide loan. By changing the margin requirements, the Reserve Bank can alter the amount of loans made against securities by bank. Okay, if there is some, I will send you the notes to you. Okay, so can alter the amount of loans made against the securities by the loan. So the valuation margin requirement, okay, is being decided by the central bank itself, and deciding that margin requirement only, the central bank hamper the borrowing and the lending capacity of the public and the commercial bank. So today up till this much your chapter of banking has completed. I'll be sending you the study material, the book pages and the topics covered, which I have written the notes in my own hand. I will send it to you. Go through it. I'll give you the questions. You have to write it in proper answers. Any questions you have, you can able to ask me, as every day I tell you, and in copy the answers should be written by giving date.